Hi everyone, good morning. My name is Deepak Visht, and previously in our previous episode, we have discussed about what does a loan term means and the meaning of loan term, the key financial distinctions, characteristics of a loan term with loan term B, what is the meaning of covenants, who uses loan term A, uh, pros and cons of loan term A from a borrower's and a lender's perspective. Now, today we are going to start with again a very important topic, the meaning of a loan term A in a contract. So, what does a loan term A means in a contract? So, why does a contract matters more than labels? So, let's begin with a critical distinction. In everyday English, the word term means that the word term actually represents length, length of the loan. To length of time actually. And in contracts, in the intuition, this intuition will actually mislead you. When a credit agreement refers to a loan term A, often written as loan term A or a tranche A, it's not describing how long the loan was last. It actually describes a legally defined financial instrument actually, and in other words, loan term is not a timeline, it's actually a contractually engineered debt facility. So contractually engineered debt facility. So don't get confused that because it says term doesn't means time here. This is actually a specific kind of a contract. it's a- actually it's It's actually a specifically engineered contract, contractually engineered debt facility. So understanding this distinction is essential if you want to read, negotiate, or value or enforce credit agreements. Now, understand this in contracts or in loan term A. So when we talk about contracts, loan term A is actually defined as uh, uh, the defined terms are capitalized, precise, and legally binding. So, loan term A refers to a uh, specific tranche of debt governed by its own commercial terms within a larger credit agreement. And a single credit agreement may include multiple factors such as loan term A, loan term B, revolving credit facility, and delayed draw term loan. And each of these tranches actually share a common legal framework but has separate economic and risk profiles. And also repayment rules are also different for every credit agreement. Uh, okay, so think of a credit agreement as building. And okay, think of a credit agreement as a building here. And each tranche is actually a floor. Previously also, when we talked about securitization and tranching, we discussed about this. So each of this building as a tranche, or and each floor as a tranche. Think of this as a tranche, and these tranches actually connect, but the functioning is totally independent. If you think about it, so these are actually connecting each other, but their functioning is totally different, totally independent. So how this tranche is going to work is totally independent of how this tranche is working. The tranche one is working, how the tranche four is working. So they are contractually structured, but functioning is totally independent. And when This separates these separate economies, but share legal structure. So that's what this diagram is trying to explain here. Now let's talk about where loan term A appears on a contract. So when you read a real credit agreement, you will see that a loan term A when you will see a loan term A reference repeatedly, including the definition where it's legally created, the facilities clauses where lenders commit capital, repayment amortization clause, which means the cash flow obligations, how the borrower and the lender are actually going to repay, and how the lender is taking in the money from the borrower. Interest clauses means this determines the pricing. The covenant section is which governs the behavior of the borrower, and even in what to do in the events of default. So which defines failure, and waterfall, priority of payments, which governs the downside outcomes. So this tells you something important. Loan term is not incidental; it's actually embedded throughout this contract. So typical, when we talk about contracts, so typical definition from a legal perspective, the typical definition may read that a loan term A means that the term loan facility is an aggregate principal amount of XYZ of dollars. Let's say XYZ dollars and made available to the borrower pursuant of section number, pursuant to section, I have no idea, but so you can fill in whatsoever you want, having the repayment, interest, and maturity terms set forth herein. So this is how does a loan term A contract looks like. And the key takeaway here is that the loan term A is actually legally distinct from the other tranches. Its rights and obligations are enforced independently. And this means a default under loan term A can trigger remedies even if other tranches are current. And pricing, repayment, and covenants apply specifically to this facility only. So the core contractual features of loan term A, the core contractual features of loan term A. Uh, so if we discuss about this, now okay, let's walk through the economic engine of the contract, clause by clause. So this is how a contract looks like: facility amount, maturity amount, amortization. So these are the core contractual features. And even though some of them are common, but we are specifically talking about loan term A. So facilities amount. The facilities amount clause actually states the maximum principal available, and often specifies that the loan is fully funded at closing. Uh, for example, lenders agree to a available make available a term loan A in the principal amount of $50 million. So this is a statement which states that the lender has taken a loan out principal amount of $50,000, 50,000, 50 million dollars in the form of loan term A. And the lender has agreed to make this available under loan term A. And this clause defines lender's behavior or lender's exposure as long as the borrower's leverage at inception. So the borrower is actually borrowing this at the inception, and the lender's exposure. So lender is willing to give a debt of $50 million dollars, and the lender uh, can leverage this. And it's a starting point of actually, this is this actually, it's the starting point of risk. If we talk about it from the perspective of risk. So now, based on other factors, the lender would want a return here in this situation. So okay, now let's talk about maturity date. So maturity dates is actually it's contractually fixed, typically earlier than other tranches, especially than term loan A. An example here is that the term loan A shall mature on the fifth anniversary of the closing date. So this means that uh, fifth anniversary is the fifth year after 5 years, fifth years. So the tenure of the loan term A is 5 years. So these are the technical definitions which you will find in a term agreement, loan term A agreement, loan term agreement, loan term A loans. So they are actually structured. If you read the language, these are structured in a very fashionable way, in a fashionable way, which might give you an idea of British English. So these are actually fashioned in British English. Okay. And after the facility amount and the maturity date, so we have decided this is representing principal, this is representing time or tenure. Now amortization schedule. So amortization, this is the most important clause of law in loan term A. So amortization schedule defines mandatory principal repayments and at a pace and the pace at which the risk is actually reduced. So this is actually example from a loan term A agreement. So the borrower shall repay the loan term A in equal quarterly installments equal to 5% of the original principal amount with the remaining balance due at maturity. So here they are talking about installments, quarterly frequency. This is talking about frequency, 5% of the original principal amount. This means this interest rate, 5% of the original principal amount. This is representing interest. Okay, EMIs. Sorry, my bad. EMIs. This is representing frequency, and these are representing EMIs, installments. So this clause actually does three things. It actually forces steady deleveraging, reduces lenders' exposure every period, and converts performance into contractual obligations. And failure to pay in an event or default, there is no discretion here. So you cannot be discreted. You cannot be let go if if there is any failure in the event. So necessary actions will be taken against the borrower. Now, after this, there is a clause for interest in the term loan A agreement. So, interest clause actually defines the interest defines the principle of the price of remaining risk. So, interest defines the price of remaining risk, and it specifies a base rate, a margin, interest period, and payment frequency. And the example here is that the interest shall accrue at the rate equal to SOFR plus a 2.25% per annum. This means that because principal declines over time, the margin is typically lower than other tranches. And this is not generosity; it's pricing discipline aligned with declining risk. So when we think about interest rate, and if you in interest clause, if you remember uh, during the amortization, when we talked about amortization, okay. So if you see here, now the interest is actually declining. So interest is declining because now the outstanding balance is declining. This means our risk is actually declining. That's why we are the interest component is reducing. So this is what the clause is. This is what the clause actually explains here is that it's not generosity that the interest rate is declining, but it's a disciplined alignment with declining risk actually. So it's a disciplined alignment with declining risk. When we talk about the prepayment terms, so loan term A usually allows prepayment, voluntary prepayment without penalty, and mandatory prepayments from defined sources, including asset sales, excess cash flow, or insurance proceeds. And the example of the prepayment payment in a loan contract is the net proceeds from asset dispositions shall be applied first to term loan A. And there is a logic behind this. During the evaluation of the credit worthiness of a borrower who is going to receive, who is going to apply for loan term A. So if now look at these elements. So asset sale, excess cash flow, and insurance proceeds. Because loan term A is said to be secure, so it actually has a claim. It actually has a senior claim in all the cash flows or all the event of if there is excess cash flow. So we actually first pay back to our loan term A. And why first? Because loan term A is designed to exit the capital early, the capital structure early, and prepayments are not optionally generosity. These are not optional generosity; they are contractual extraction. And if we pay it first, so because the interest amount is also lesser here, and they actually have the first claim uh, to the cash flows. So that's why. And it's actually designed. So loan term A is actually designed in such a way that uh, they actually exit the capital structure early. And understand this thing, prepayments are not optional generosity. So they are contractual risk extraction, contractual risk extraction. The understanding about these securities is actually technical in nature, but these are important, and I would want you to pay full attention for a few more minutes. I will try to wrap this up as soon as possible. Maybe 10 minutes more. I'll try to wrap it up. Okay, so now let's understand covenants of specific loan term A. So loan term A, so the common examples for maintenance covenants include uh, maximum leverage ratio, maximum interest coverage ratio, and maximum liquidity threshold. And these are maintenance covenants tested periodically, not just at any occurrence. So they function as an early warning system. Why? Maximum leverage ratio, minimum interest coverage, and minimum liquidity threshold. Because these work as a early warning signs, early warning systems, maybe. That would be the correct word to say. These are behavioral constraints and triggers for lender intervention. Until unless you breach any of these covenants, so the lender will not interfere into your management or into your operations. But once you breach any of these contracts, so this will be a trigger for lender's intervention. When we talk about affirmative covenants are those covenants which are also the do's, and the negative covenant are the don'ts. Let's talk about the do's and first the do's. So these require borrowers to provide financial statements, maintain insurance, pay taxes, comply with laws, and when we talk about negative covenants, so negative covenants are those covenants which prohibit the borrower from, which stops. So these are do's and don'ts. Simply say, if you say it simply, uh, simple words, incur additional debt. So since they have already debt, so they cannot raise more debt based on these financials. Pay dividends. It actually prohibits the borrowers to pay dividends because dividends are for the equity holders, and that does also make sense. So dividends are actually for the equity holders. So there are different checks in the financials to see if there is if any covenant is breached. And, the third negative covenant is selling assets beyond limit. So you are also not allowed as a borrower to sell assets beyond limit. So long-term A lenders rely heavily on these restrictions because control is important as collateral. So as important as the collateral is, so collateral is important, but control is also important. Control is as important as collateral. Now let's talk about security and the priority. So loan term A typically is a senior secured loan, and seniority, it's a senior secured loan, sharing collateral with other senior tranches, and it's paid before subordinate debt. Yes, we know that. And the contract specifies that there should be a collateral description, there should be a lien priority, and there should be an intercreditor agreement. So this determines who get paid and when, and during the time of distress, who get paid and when. When. Okay. So this is somewhat similar to what we have discussed previously also. So these terms in the contract are somewhat similar to the definition, the terms which we read those terms which we read about in the definition part. So during the event of default related to loan term A, common features of default include failure to pay principal or interest. So this will be considered as a default. So failure to pay interest and principal, breach of covenant would be considered as default. Insolvency will be considered as a default. So these are the events of default. Cross default to other debt. If there was any cross default to other debt, so that would be considered as the event of default. And during the event of default, loan A, term loan A may be accelerated. To learn term loan A may be accelerated, the entire balance become immediately due. And acceleration transforms a slow moving obligation into an intermediate crisis. So if any of these contract is breached, any of these terms is in any of these events happen, so this breaches the contract and the entire balance is due immediately. So you need to understand the long term A because during the waterfall structure, we need to keep all these factors in mind. Understand this thing. This is why we are uh, talking about all this thing in detail. In waterfall debt structure, if you have to make a waterfall debt structure, then uh, you need to be. I mean, these concepts should be on your fingertips. These concepts should be on your fingertips. All right. So now, now let's understand the role of loan term in a waterfall. So contracts often specify a payment hierarchy. The fees and expenses, revolvers, loan term A, loan term B, subordinate debts. So this ordering reflects risky seniority, uh, risk seniority, repayment discipline, and contractual conservatism. So loan term A sits high because it is designed to exit early and safely. Why contract separate loan term A? So that's the why does a contract separates loan term A? And from a legal financial perspective, so separation allows different lender groups, different pricing structure, different amortization profile, efficiency, syndication, and protection from conservative capital. So this modular structure is intentional but not cosmetic. And to answer uh, this question, why contract separate long term A? Because it's intentional actually. This is not cosmetic. It is actually intentional. So understand this thing. Uh, Long term A uh, is designed to exit early and to protect the conservative capital, conservative lenders. So they do not want way too much, uh, way too much return, but they are conservative in their approach. They want a certain amount, certain the minimum interest above the yield, above the risk-free rate, and that's it for them. So, but they do not want any risk with their capital. So that's why these contracts are designed in such a way. And in plain English summary, so in contracts, loan term is not a duration; it's actually a legally defined loan facility with mandatory amortization, lower interest rates, and strong leader protections, along with higher borrower discipline. Its purpose is simple: it actually reduces credit risk through structure and not through hope. If you understand the loan term A at the contract level, you understand how risk, cash flows, and controls are legally engineered in modern finances. So if you do not if you find any difficulty understanding this concept the loan term, I would suggest you to revisit this episode, this lecture one more time so that it gets clear. uh, you get a better grasp of it. And what you can do is you can do some research of your own also. uh, you can google these things. You can use any AI platform to read, to study. But the thing, understand this thing. So you need to understand the basic concepts first before you start to apply them, because this is not a complex problem. But if you talk about a waterfall structure, that's where that's where every concept is being applied. So unless until you understand the basic concepts, you will not be able to apply it cumulatively or in a on a bigger picture. So that's why it's very important to understand. uh, that's why I'm putting in special emphasis on the learning rather than the application. So you need to learn the concepts first, and then only I would suggest you to apply, because on a bigger data set, if you apply these concepts without any clarity, so it's going to be difficult for you. It's going to be difficult for you only. All right, then I hope you have learned something of value today. I will see you in my next lecture. Thank you for attending today's lecture. My name is Deepak Best.